Hi, this is James Eng of Old Capital, and today we are doing a April 2022 update on the apartment market and the financing market. And so I want to start with this curve, and this is like the opposite of a roller coaster. We're going up instead of going down, and it's just as scary. So here is the projection, and this is for SOFR, which almost every floating rate product, whether it's non-recourse bridge, whether it's Fannie or Freddie, this is what it is based on. And so as you can see, we're sitting at probably 25, 30 basis points today. And then almost every projection is about 4 to 5 50 basis point increases over the next 4 or 5 meetings. So Fed has a meeting 4 to 5 or once a month, and this is a projected curve. So you could be at 2.5 3%, and this is your base rate. So whether it's SOFR plus 325 400 over, your all-in rate could be 6.5%, depending on the cap that you bought. And so this is what we're going to start with today, and let's jump into why the forward curve is the way it is. Pretty much the inflation that is being registered right now is 7 8 9%, depending on which one you look at. And the Fed wants to keep that at 2%. And so they are really cranking on interest rates to bring that down. And then one thing that is even harder to see is they are buying less treasuries. And so the Fed's balance sheet essentially doubled during COVID from, like, let's say 4 billion to 9 billion, or sorry, 4 trillion to like 9 trillion. And now they're bringing that back down. So they're going to stop buying bonds, and then they're also going to increase the federal funds rate. So how does that impact you as an investor? Number one, your debt service is going to be higher. Your interest rate caps are going to be higher. It's going to be harder to refi out of your bridge loans to Fannie and Freddie. And so what that is going to impact is the price that some of these properties are going to go for. There might be a gap, right? So there's just going to be less people at the table, I think, on some of these deals, depending on the pricing expectations of the seller. And so that's what we're going to talk about in today's update in terms of the market, in terms of multifamily financing, and then go through some case scenarios on what the impact is for people, whether they're buying a deal, are in a deal, or trying to get out of a bridge loan, and how to make sure you stay in the game long term, because I think this is a short-term phenomenon that not many people who have been in the business, let's say the last 5 to 10 years, they have not had to deal with a rapidly rising interest rate environment. So that's what we're going to talk about today. My background: born and raised in Houston, went to school in Austin at UT, was an underwriter at GE Capital for 8 years, and then have been at Old Capital now since 2015. Done about 1.2, 1.3 billion in multifamily loans, and then also invested in probably 35, 40 properties in the last 7 years. And, probably half of those have sold already. So in about 25 properties right now throughout DFW, Austin, and Houston. All right, so this is where we're starting, right? So in terms of inflation, everything's more expensive. You go to the grocery store, it's more expensive. You go fill up your tank, it's more expensive. The rent at all these places is more expensive, right? So they're seeing inflation at close to high single digits, the way that they're tracking it. And a lot of people are saying this should probably be 15-20% on inflation right now, and the Fed's target is 2%. So they're way off on this right now, and so they're getting a lot of pressure to bring this back down. And so how they're going to bring it back down is really they're going to crank interest rates. So you're going to see interest rates, federal funds rate, keep pushing up. And whether the cap's 3%, 3.5%, the forecast is they're just going to keep pushing until they see inflation come down. And they're still trying to keep. Right now, there's more jobs than there are people, it seems like, applying for these jobs. And so they're at full employment essentially already. And so their mandates are full employment and really 2% inflation. So they're really fighting the inflation right now with this forward curve. And then, as the forward curve, that's really the front end of the yield curve. And, right now, towards the end is really the 10-year and 30-year treasury. And 10-year has just been on a tear. This year, it probably started at 1.5, 175, and now it's almost doubled to 290. So in that 290 range right now, 10-year Treasury. So this is actually a historical chart that I thought was pretty interesting. It compared the federal funds rate to 10-year Treasury. And you can see that pretty much before every recession, that federal funds rate is going up and crossing into the 10-year Treasury at some point, right? So that's usually when it starts signaling that's why they're going to stop, right? So that's why if you look at this forward curve, pretty much is everyone is taking it all the way up to the 10-year Treasury and then stopping, right? So they're looking at this historical federal funds, and whether it was before 2001, they sort of hit it at 6% with the 10-year Treasury. Same thing here at 5%. And then on the last recession, really, it was closer to 2.5%, 3%. And so 10-year Treasury is sitting at 3%. Federal funds is supposed to crash into it at 3%. And so that really is what people are projecting. And that's why so many people, whether it's banks, whether it's, economics professors, they're predicting sort of a recession at that point in the time. And it really depends on how far the federal funds rate goes into that 10-year Treasury that people are going to stop predicting that. And so, all that stuff is more challenging for investors, right? So if you look at these things, debt service increasing, interest rate caps are more expensive. It's harder to refi out of the bridge because your fixed rate is higher. So what's good for apartments right now? What's good for apartments right now is rent growth. So inflation adjusted rent growth is essentially allowing. So if you look at these, this is a B deal in Carrollton that I'm invested in, and essentially look all the one bedrooms. Look at these increases, right? So it's going from $800-900 all the way up to $1,100-1,200, and then the two bedrooms, so the B7, B6, all those are going from $1,200 to $1,500. So you're seeing these 20% rent increases. You're seeing a ton of loss to lease in these rent rolls. I mean, when this is the average across the nation, $1,400 going to $1,600, you're seeing that $200 pop pretty much across the board. And so you're trying to capture that increase without giving all of that upside to the seller, right? So you as the buyer, you want to come in, buy the deal, but then also you want to get some of that upside for you as the buyer, depending on the purchase price that you buy the deal at. So we're seeing a ton of rent growth. That is probably the number one driver of demand. And the ability, like if inflation keeps running, that not only next year, let's say the rents get to $1,200 on a one bedroom, $1,500 on a two bedroom. Next year, if inflation is still high, your taxes are higher, your insurance is higher, your payroll is higher. That's going to be a reality for all landlords. They're just going to keep increasing the rent another 8%, 10%. And so you're able to reset these rents compared to other property types, let's say office or retail. Those are sort of set rents. And so what's funny is on those deals, you can, you as the landlord, you can't charge more. You can't restructure the lease. But then if retail tenants or office tenants are in trouble, they typically come back to the landlord to restructure the lease on those long-term leases. So with multifamily, you have this flexibility because essentially you are 97, 98% occupied right now. And so that allows you to have a ton of pricing power. All right. So in the next year, it's going to be difficult, right? So the rates are going to be coming up. Inflation is going to be higher. But here's a forecast out of Moody's of sort of where inflation is today. So, close to 8% on average. And their target down here, or the Fed's target, is, 225 approximately. And this is sort of the timing of when they think it's going to abate, right? So they're thinking oil pricing is going to go down. They're thinking hopefully this war ends. The supply from all that comes back into control. There's really no pandemic related stuff. And then, so if all that happens, then, by 2024, we'll be back at a nice, easy 2% inflation. And that will allow the Fed to really calm down and bring back, either keep the federal funds rate where it is or bring it back down if needed. And the other piece of this is that almost from every first rate hike to the first cut is typically on average 2.2 years. And so, these are pretty aggressive rate increases. It's anywhere from 1.5 to 3 years and then on average about 2 years. So you're going to see rate hikes for at least 2 years, and then probably it's going to come back down. So that is what everybody's projecting. But I think with inflation so high right now, these rate hikes are going to be a lot quicker. And, most people are calling for 50 basis point increases. Some people are calling for 75 basis point increases. So it's going to come really quick for a lot of people. And so that's sort of what's going on in the macro economy in terms of interest rates, in terms of 10-year treasury. Let's go into how that impacts you on the financing side of multifamily right now. Across the board on the bottom, you can see interest rates for all these products. So recourse bank loan, 425 to 4.5, Freddie Mac, Fannie Mae. If you do a fixed rate right now, you're probably 475 to 5. And then non-recourse bridge, you're really starting at that like 4.5% range all in. And then if you get, more expensive debt, maybe if it's under $10 million, you're going to have a higher interest rate. So you might be 5 to 6% on some of those deals. So we're going to start with non-recourse bridge. That seems to be, Old Capital did about 500 million in multifamily loans in the first quarter of 2022. And probably 75-80% of our stuff was non-recourse bridge. So we're going to start there and talk about the changes that are happening on the non-recourse bridge side. All right, so let's start with this first one. So with the increase in interest rate, your debt service is going to start increasing, right? So you have to underwrite this now in your model, right? So let's take this deal. This was a deal, I think it was about a $20 million loan. Your debt service, might start at $1 million, but then if you increase your rate from, let's say 4.5 to 6.5 in year 2, and then let's say you bought a cap, so your interest rate's only going to increase by about 2%, then you have to underwrite this, right? So, your cash flow in year 1 might be 700,000, but then by year 2 and year 3, it's going to go down unless your NOI is picking up by that much. And so you want to make sure that on these bridge loans, you sort of underwrite that debt service increase. And then if you can't sort of, like, obviously you want to be above a 125 debt service cover. If you can't, you need to either increase your NOI forecast and make sure that's realistic, or buy a lower cap to keep your debt service lower on these deals. All right, so the second impact is that as these interest rate, this forward curve is increasing, it's impacting the interest rate cap cost, right? And so, like, I would say, 1%, this is a $10 million deal, a 1% strike, probably 6 months ago, it was probably $30,000, and now it's $357,000. And so these interest rate cap costs are increasing significantly, and it's about 2% of the loan amount, these interest rate caps at a 2% strike for a 2-year term. Hopefully you got that 2-year term, 2% strike rate is costing about 2% of the loan amount. And so now when people are asking us, all right, what do I underwrite for closing costs on a non-recourse bridge loan? It's about 5 to 6% right now. So you've got, your origination fees, you got your application fee, the lender legal, borrower legal, title fees, and then this interest rate cap. So the interest rate cap is adding about 2% to your closing cost on these non-recourse bridges. All right, so this is the last piece on, if you do a bridge loan, typically the term is anywhere from 3 to 5 years, and then you have to refi to Fannie or Freddie. And so usually bridge loans are looking at debt yield in year 3. And what they typically did was they used probably like a 7.25, 7.5 debt yield in year 3, and they wanted you to be able to refi out in the Fannie or Freddie. And so Fannie or Freddie, they look for a 125 cover on typically whatever the going rate is. And so today's going rate on Fannie and Freddie is about 5%. And so let's look at this example and see how it's impacting you initially. And then also for people who are in bridge loans right now, how it's impacting you on the refi. All right, so let's say this deal is 75% of purchase, 100% of rehab, $23 million loan. If by year 3, you're getting to a 7% debt yield, it's 1653, or sorry, yeah, 1.6 million on a 5% interest rate, and the debt service on a 120 for Fannie Mae would be about 1436 at that loan amount. And so that debt service cover is only 115, right? So when this interest rate, let's say a year ago, was 4%, a 7% debt yield was fine, right? Because you still got to a 125 debt service. But now that the interest rates have come up, the debt yield that a lot of lenders are looking for are closer to 775 or 8% even, to make sure you cover at a 125. So this is the calculation. So they want this NOI if you're going to have that loan amount. So they're going to want a 775 debt yield to get to this loan amount to get to a 127 cover. And so most of the time when you submit your pro forma, that's usually the best case scenario, right? The appraisal is typically going to come in a little bit lower on revenue, a little bit higher on expenses. And so it's going to be lower. So what's happening right now is this quarter, as we get quotes back, because of this higher interest rate, lenders are having to underwrite, let's say a 775, 8% debt yield on the exit. And so what that ends up being is you end up being 65 to 70% of purchase, 100% of rehab. So 21.5 million at this year 3 NOI of 1731, which is your year 3 here at a 5% interest rate. Debt service is 1385 on the refi. That gets you to the 125. And so that's what we're seeing people that's the new bridge loan leverage, right? So instead of it being 75 to 80%, which we saw last year, this year we're seeing closer to that 65, 70% of purchase, 100% of rehab on these bridge loans. And so whether you're doing a new deal or if you're in an existing deal and you're trying to refi, this is the calculation, right? So as soon as you hit this number, let's say you hit that number in month 18 and you can get to a Fannie or Freddie floater, this is what you're going to be refining to. And so that is the calculation of how to refi out of these bridge loans. And remember, always begin with the end in mind. So this is how bridge loans are getting underwritten right now to make sure you can exit out of Fannie and Freddie in year 3. In terms of commentary on bridge lenders right now, I mean, there's definitely still a lot of bridge lenders in the market. I would say their focus really is 20 million and up on most of these bridge loans, and they're wanting newer stuff, really. So, A, B stuff is their focus. They're looking mostly in major markets, and those are going to get the lowest spreads. So as you move, let's say, lower in loan amount, lower in quality, further away from these MSAs, your interest rate spread is going to increase. And so you're going to have to build that in and make sure you talk with someone at Old Capital about how to underwrite your deal for secondary markets, for smaller deals. And we can start, taking that out to market to figure out what they're going to want. A lot of times, instead of, let's say, a normal deal in DFW might want a 7.5 to, let's say, 775 to 8% debt yield. On these smaller deals, they're going to want even a higher cover because Fannie and Freddie might want a 130, 140 cover on the exit. Here's an example of a deal out in Colleen. 75% of purchase, 100% of rehab, SOFR plus 375 that we closed in the first quarter. 1% prepay. So this allows you. So this was a newer deal. So this was 1995 construction, more of a secondary submarket. But still good terms, good pricing. And it really is, this was like 95% occupied, right? So that in place, that yield going in is also very important. So they want to see, 4.5%, maybe 5% in place that yield going in to make sure you can hit this number. All right. So as you saw, the majority of these deals are going non-recourse bridge. As people in the multifamily space, graduate from single family, they come into multifamily, they want non-recourse bridge. But now it's getting pretty expensive, right? We saw the closing costs, they were close to 6% on these deals. And the terms are sort of not being competitive, I would say under 10 million, right? So a lot of people are shifting all the way over to the other side of the spectrum, bank loans, and looking at, all right, what can I do with a bank loan and the terms on those? And so, those are typically 3 to 5 years, has, 1 to 2 years of interest only, and the fixed rates are around 4.25 to 4.5. So let's take a look at what these bank loans are and why people are doing them. So it's fixed interest rate, no interest rate cap. So these guys are getting money from the deposits that you're putting at the bank, right? So they're not going out securitizing these loans. So they're making the decisions right at the bank level, whether it's local or regional. Now, no cash flow sweeps, no lock boxes. They're going to close in 30 to 45 days. And then there's low legal and low closing costs. And so I wanted to show this example. So this is a $10 million deal. And we were talking with the client trying to figure out, all right, do you want to go non-recourse bridge or you want to go recourse? And these are the big differences, right? So on this recourse bank loan, you can see lender legal might be 10 or 15,000 compared to 50,000. That saves you some money. And then this interest rate cap, remember, it's 2% of the loan amount. So your all-in closing costs on a $10 million deal was about 300,000, 3%. And then on the non-recourse bridge, it was closer to 6%. And so as you think about, all right, which way am I going to go? If you're comfortable signing recourse, we typically see where, let's say it's a 1031 buyer, it might not be a $10 million loan amount, it might be a $7 million loan amount or $6 million loan amount. They're putting down 2 or 3 million, and then they're getting a recourse bank loan, and they're saving $300,000 on closing costs. But let's flip over, and you're not only saving the closing costs, but now you're also saving, remember, we had to underwrite those higher debt service on the non-recourse bridge, because the non-recourse bridge is tied to SOFR, right? So SOFR, if it goes to 2%, 3% from here, you might start at 4.5%, but then you're going to be 6.5%. So it might cost you another 350,000 in terms of interest, and then your closing costs another 300,000. So now you're going to be sitting at $650,000 on a $10 million loan in terms of difference between a non-recourse loan and a recourse bank loan. So definitely talk to us about your deal specifically and how it might make more sense to look at a recourse bank loan if you guys are comfortable signing. Obviously, if it's a syndication and you're going to spend, you might have 4 or 5 guarantors on it, and everyone's got to get comfortable with recourse bank loans in order to save that money. Here's a deal that we did up in Denton, 97 units. This was done sort of Q4 of last year. It was fixed at 365. So since federal funds have come up, this is probably closer to 425 right now. But 5-year term, 24 months IO, and then 25-year AM. It's got step down prepay, and then this one was done in about 45 days. So as you look at deals, and as you're trying to be more competitive in let's say a lower loan amount space or a $10 million and under space, this works really well. All right, let's go over to Fannie Mae. So Fannie Mae, I mean, they have done, so their mandates, Fannie and Freddie are to do about 80 billion a year. I would say in Q1 their volume was okay, but Q2 is looking super light, right? So they do some floating rate and a lot of fixed rate, but fixed rate is really tied to the 10-year treasury, and that's moved significantly. And so this is it's going to be a little bit more challenging for Fannie Mae right now. So let's talk about, all right, so look at this. Beginning of the year, their rates were about 325, 3.5. So pretty much you should have locked in everything at the beginning of the year, it seems like. But the challenge was most deals did not have this leverage. Most of the leverage on these deals were like 50 to 60%. So it was hard to do Fannie Mae at the time. And then now rates have moved like close to 100, 150 basis points. So now you're seeing rates. So this is a conventional deal, conventional being there's really no affordability in so they look as a percentage of AMI, how many, what percentage of people can afford these units. And on this one, there was not much affordability on this $20 million loan. So the rates were, in the fives, low fives. This is a deal where more than a quarter of the units were affordable. And so Fannie Mae is becoming more aggressive on those units, and their rates are, 4.5 to 475 on the 10-year. And then, the 12-year got up to about 5%, depending on what you chose. And so it's tied to this. If you see this increase from January, 1.5%, that pretty much they doubled, right, from the beginning of the year to now. So that's going to have a direct impact on your fixed rate Fannie Mae. As soon as your bridge loan can qualify, I would probably roll into, these are fixed rate, but Fannie Mae has a floating rate product that I would look at as well. So this was a Fannie floater that we completed over in Garland, 60% LTV, SOFR plus 250. So even if SOFR runs, 2.5%, 3%, your all-in rate's 5.5%, and your fixed rate right now is 5%. So as long as you can sort of stomach the monthly increases and changes, you have that flexibility of a 1% prepay. I would say, like I got a lot of questions this weekend just about how people should be looking at, preparing for these interest rate caps. And the main thing is liquidity, right? So these interest rate caps are going to cost 1-2% of the loan amount. And you've got to have that liquidity at the either partnership level for these syndications, or at the general partnership level where people are able to put that money in, or you're going to have capital calls because most people are buying 2-year caps right now, and you're going to have to go out and buy that 3rd-year cap if you stay in the deal. All right, so let's flip over to Freddie Mac Conventional. Freddie Mac Conventional is pretty much humming along the similar way to Fannie. Their leverage is significantly lower than Bridge right now. They're in that 45 to 50% range. But I would say Freddie Mac Conventional starts at 7.5 on the floating rate side. So if you have a smaller deal and looking to refi that, that might be a way to do it. And then, Fannie and Freddie have different markets that they're more aggressive in. So this was a deal out in sort of East Texas, Longview, and they had 1031 money. So they had plenty of money to put down, about 40%. They did 60% LTV. And then you're able to do a floating rate out there, 275 over SOFR, and get, 3 years IO, 10-year term. So that's still a way of doing deals. As you sell deals, a lot of owners still have a lot of capital to put to work. They don't want to pay taxes on, so they're 1031ing into other deals and just putting more down. So that, and just getting a lower rate. So instead of, bridge loans should be priced higher than Fannie or Freddie, right? Because it's just an inherently more risky deal if you're having to raise rent significantly. And so, Fannie and Freddie, they're sitting at, SOFR plus 250, 275 in comparison to bridge loans, which are going to be SOFR plus 400. So that additional 150 basis point spread, if these rates keep running, that's going to be a huge difference to keep your debt service down. So let's move over to Freddie Mac SBL. So Freddie Mac SBL, they're tied to the 10-year treasury as well. So they've seen rates run significantly. I would say the one benefit of Freddie Mac SBL right now is you can lock in your rate right at the beginning. So you know that it's not going to keep running. Make sure you get all your due diligence in and close within 60 days. But, here's the rates. I mean, in these top markets, they're all, north of 5%. There are some different things that you can do in terms of IO, in terms of prepayment penalty that can change this rate. But around, I would underwrite probably about 5% on these Freddie Mac SBLs right now, and then get it quoted through us to make sure you have the best rate. Here's a deal that we did. This is probably, 4th quarter last year, 7-year term, 2 years IO. This one cash flowed pretty well based on the purchase price. So 74%, mid 3% fixed rate. Obviously that's run now, and then a step down prepayment. So here's some of the deals that I closed probably in the last 12 months. So a mix of Fannie Mae, non-recourse bridge, Freddie conventional. So all throughout the spectrum in terms of, 200 units down to 36 units out there. So, Old Capital is a mortgage broker. So what we do is stay abreast of sort of the entire market, figure out whether it's Fannie, Freddie, Bridge, CMBS, HUD, construction, what the best option is for you as you go out there and you're trying to buy deals, refinance deals. We help you on the front end of the deal, but then also during the deal to make sure you're getting the best terms on the deal. And then also after the deal, whether it's helping you with asset management, helping you with loan servicing, highlighting you, whether it's our podcast, our conference, Facebook group, networking events, all that type of stuff. And then we charge the same as everybody else. So we charge essentially 1% of the loan amount at close. So, in terms of next steps, definitely if you have learned something today and like this video, definitely like the video, subscribe to the channel for the next. I try to put out a couple of videos a month at least of what's going on in the multifamily space. If you need help with a term sheet, definitely send me T12, rent roll, OM, whisper price, and then I get you a loan term sheet on what we're seeing on that deal. If you're looking at a deal as an LP and you have some questions, how's the GP doing this? How are they underwriting it? Definitely send it to me. I'll review the package and give you some questions to think about on that. And then, if you're just getting started and you really need to complete your personal financial statement, really get set up, qualified, send me an email, and then we can go through, how to look at, buying your first deal or selling your deal or refinancing your deal. And then, Old Capital is constantly looking for great people. So if you are interested in joining Old Capital, if you made it this far in the webinar and you're interested in joining Old Capital and working more in the financing space on the multifamily side, definitely send me an email with your resume, and we can take it from there. So appreciate everyone joining today. And if you have any questions, feel free to reach out.